Okay, we should be good to start. So, topic 7, which is capital dividends. This is a relatively short topic. We hopefully will finish it in the time that we have remaining today, and in a perfect world, we might get to end early. So that's the good news. Capital dividends. So let's start with talking about why capital dividends. And as a size in the handout note, capital dividends are really a neutrality thing, right? So when we've talked about neutrality so far, we've talked about making sure that the combined corporate shareholder rate applicable to income is the same as if the shareholder had earned that income directly, or is mostly the same as if the shareholder had earned that income directly. But there are also times when if a shareholder had received an amount directly, that amount would have been tax-free when received. And so in order to preserve neutrality, we don't just need ways to set rates. We also need ways to make sure that distributions from a corporation can be completely tax-free in some circumstances. And so this is where capital dividends come into play. A private corporation maintains a pool from which it can pay capital dividends, and that's called the capital dividend account, which is defined in subsection 89(1). If a corporation designates a dividend as a capital dividend paid from its capital dividend account, then that dividend is excluded from the shareholder's income under subsection 83(2). Furthermore, unlike a return of capital on a share, or say a dividend paid from the pre-acquisition surplus of a foreign affiliate, a capital dividend has no impact on the ACB of a shareholder's share. So it is a purely tax-free transaction rather than a tax-deferred transaction. So what this means is that the capital dividend pool of a corporation is tremendously valuable to the shareholders of the corporation. So if we then flip to slide 3, we have some details about the process of paying a capital dividend. So a capital dividend requires a corporation to affirmatively elect that a particular dividend is a capital dividend under subsection 83(2). The election is made by filing CRA form T2054, and that form has to be filed together with a certified copy of the resolution declaring the capital dividend, as well as a calculation of the corporation's CDA at the point in time when the dividend was paid. All of this has to be filed on the earlier of the date that the election is made, or the date that any part of the dividend was first paid. There is a penalty for late filing, obviously, since there's a deadline. The penalty is really not very onerous. It's like $45 a month is generally the penalty. So almost everybody pays the $45 and files the form after the dividend has been paid. But in theory, you could predate it and not have to pay the $45 penalty. So like eligible dividends and GRIP as the corresponding pool, capital dividends are linked to the CDA balance. So electing to pay a capital dividend in excess of a corporation's CDA balance results in Part 3 tax being imposed on the dividend payer corporation under subsection 184(2). And that Part 3 tax is equal to 3/5 of the portion of the dividend that exceeds the corporation's CDA. So it's a very burdensome tax, right? It basically assumes effectively a shareholder tax rate of about 60% in imposing Part 3 tax. So you generally would want to not pay that, all things being equal. And like Part 3.1 tax with excessive eligible dividends, there is a mechanism in Part 3 to elect out of the capital dividend where you have a problem. That's in subsection 184(3). And where you make the election under subsection 184.3, the excess portion of the capital dividend gets deemed to be a taxable dividend that's received by the shareholders who receive the capital dividend at the same time that the capital dividend was received. However, just like we talked about with elections under, to get out of Part 3.1 tax, the election under subsection 184.3 does require the concurrence of all shareholders other than tax-exempt shareholders. And so again, we find that the corporation here is at the mercy of arm's length shareholders or departed shareholders if an election is needed. And so for that reason, what we're going to see are two things. One is that people will try to do the same fixes that we talked about with Part 3.1 tax and excessive eligible dividends, where you'll try to get the shareholders to consent to a subsection 184.3 election at the time that a capital dividend is paid, and you'll hope that's good enough for the CRA. And the other thing that you'll see as well is that people tend to be fairly conservative with CDA. Like, you don't see a lot of instances where people are going to pay the CDA all the way to zero. Instead, people are going to try to leave at least a few $1,000s of CDA as a buffer in order that you don't get dinged with Part 3 tax, where you have a very minor excessive or potential excessive amount that you just rather leave some behind as a buffer rather than deal with that problem. So then we can flip to problem 4 of handout 15. And this is a fairly straightforward question that the handouts are asking. They're just asking what type of corporation may pay a capital dividend. And the answer to this question is found in subsection 83.2. And what we see in subsection 83.2 is that only a private corporation can pay a taxable dividend, can pay a capital dividend rather, because only a private corporation may designate a dividend as a capital dividend under subsection 83.2. If you're looking for a Y answer in the cosmic sense, there isn't really a hard and fast Y answer that only private corporations are mentioned in subsection 83.2. One suspects the rationale here is that the expectation is that a corporation that is not a private corporation is probably widely held enough that we don't need to try to integrate tax-free amounts for the shareholders of those corporations, that they are effectively separate economic units from the corporation, whereas the shareholders of a private corporation are likely not a completely separate economic unit. So if we then flip to slide 5, we're on to problem 5 of handout number 15. And what we are asking here, first of all, is what are the elements of CDA? And basically, what we can do is we can simplify very greatly here. The definition of CDA is in subsection 89.1. And what we see are effectively, for the purposes of this course, 3 pools. Or we can call them pools, we can call them pots, but whatever they are, they feed into the capital dividend account balance. So the first is the amount, if any, by which the corporation's non-taxable capital gains from basically incorporation to present date exceed the corporation's non-allowable capital losses. So basically the amount by which 1/2 of the corporation's cumulative capital gains exceed 1/2 of the corporation's cumulative capital losses. Second, the amount of any capital dividend that was received by the corporation from another private corporation gets added to CDA. And then third, the amount of any death benefit received under a life insurance policy as a consequence of the death of a person in excess of the adjusted cost basis of the policy gets added to CDA as well. And then so the total of all of these amounts in excess of the capital dividends paid after 1971 and prior to that immediate point in time, that's the CDA balance that's available to the corporation. And again, the rationale here is that, like you would see, all of these amounts are amounts that would be received tax-free had the shareholder received them directly. So the non-taxable portion of capital gains, obviously non-taxable. Capital dividends, if they were received by an individual, would have been tax-free. So again, with a corporation, it gets added to CDA. And life insurance, again, this is something people may or may not know generally, but when you receive the death benefit under a life insurance policy, that's generally received tax-free as well in most instances. So again, all of these things are tax-free amounts. They get added to CDA, and then the CDA balance at a particular point in time is the excess of those three amounts over the capital dividends that have been paid prior to that time. So that kind of spoils part two of the question, right? Because part two of the question is asking, well, when is CDA calculated? And CDA is a point-in-time test, right? So it's like LRIP. It's a point-in-time test. You need to figure out your CDA immediately before the time that you want to pay a capital dividend. So that's a relatively straightforward point-in-time test. So everybody okay so far there? Okay, well, seeing none, we can move on then to slide 6 and question 5 of the handout. And question 5 is, question 5 was a more interesting question before 2017. When we still had the concept of cumulative eligible capital, this was a much more interesting question. Now it just asks, well, when are all of these amounts added to CDA? And the answer is basically they're added when they're realized. So when the corporation realizes a taxable capital gain or realizes an allowable capital loss, the non-taxable portion or the non-allowable portion hits that CDA pot. Similarly, whenever at the moment in time the corporation receives a capital dividend, that capital dividend hits the capital dividend pot. And similarly, the moment the corporation receives the death benefit under a life insurance policy, that hits the life insurance pot in CDA. So it's all immediate point in time stuff. This was a really, what there was here, why I say it was more interesting. When we had the concept of cumulative eligible capital instead of having class 14.1 depreciable property, there was a huge trap for accountants in here where amounts that were received as cumulative eligible capital receipts that would be included in income didn't actually hit CDA until the end of a corporation's taxation year. So this was a significant issue where a corporation would have an asset sale where it sold goodwill and had a CEC receipt. And a lot of times accountants would immediately try to pay out the capital dividend instead of waiting until after the end of the year, and resulted in large excessive capital dividends. And you would have to go try to use rectification or something to fix the date or to change the amount in order to get rid of the excess capital dividend. So that has gone away now that we've shifted from CEC to class 14.1 assets. So no longer is that a problem. Because now goodwill dispositions just generate capital gain or capital loss like any other depreciable property would. So less interesting problem now. But then the problem goes on to ask about status. And again, sort of like we talked about with RDTUH, the question is asking, well, what happens if We know that only a private corporation can designate a dividend as a capital dividend. So what happens if the corporation has a CDA balance and ceases to be a private corporation? And the answer here is that the corporation just loses the ability to pay out its CDA. It might still maintain the CDA balance so that if it ever became a private corporation again, maybe you could argue that CDA balance kind of springs back to life, but it loses the ability to pay out the CDA. So again, this is it was a relatively important pre-closing transaction point to make sure that you've paid out non-eligible RDTH and eligible RDTH, but it is a super, super, super important pre-closing transaction point to pay out CDA before the corporation loses the private company status. Like it is inexcusable to leave CDA on the table because that's just a tax-free win for the shareholders. So that needs, should be a mental note to yourself that in any kind of commercial transaction, if there's potentially going to be a loss of CCPC status, the CDA has to come out. Or sorry, private corporation status, rather. The CDA has to come out. And then finally, the question asks, is a negative CDA balance possible? And this does remain an interesting point, is that it can't really be negative, but at the same time, it can be functionally negative. So what you would say here is that for example, any one of these, like the life insurance pot and the capital dividend received pot, those can't really be negative because they're just based on receipts. So either you have a receipt or you don't. So the lowest theoretical balance is zero. The capital gain over capital loss pot could affect it. Again, it can't really be negative because it's phrased as the amount, if any, by which X exceeds Y. But it can functionally be negative in the sense that if you have a bunch of capital losses, you're not going to have an amount X that exceeds amount Y until you've generated quite a lot of amount X. And so in that sense, it could functionally be negative by virtue of being cumulative. And then, to make matters worse, you do have to consider that CDA is the sum of the pot balances in excess of the capital dividends that were paid prior to that time. And so this can lead to some very what would seem to be anomalous results. So, suppose, for example, that a corporation realized $1 million of capital gain and then paid out a $1 million capital dividend. And then it realized the $1 million capital loss immediately thereafter, which, again, because CDA is a point-in-time test, it would eliminate it would bring the pot balance to zero, but it doesn't create an excess of capital dividend because at the point in time the dividend was paid, there was adequate CDA. And I mean, the Federal Court of Appeal has recently confirmed that that's not a garable transaction if you just time up your capital gains and capital losses in order to realize capital gains, pay up the CDA, and then realize a capital loss. But what it does is it brings your CDA pot, your CDA pot for capital gains or for capital losses to zero, but you've still paid $1 million of capital dividend. So effectively, your amount by, if any, by which the total of all amounts in each pot exceeds capital dividends paid to date is, effectively negative $1 million at that point. So then suppose that the corporation owned a life insurance policy and it received a $1 million death benefit payout under the life insurance policy in excess of adjusted cost basis, and it got to add $1 million to its capital dividend account pot for life insurance. You don't get to pay out that capital dividend account amount now, though, however, because again, since it's a cumulative amount, your capital gain over capital loss pot is 0. Your capital dividend received pot is 0. Your life insurance pot is $1 million. So the total of those three amounts is $1 million, but it's the amount you can pay out is the amount, if any, by which those amounts exceed the capital dividends paid after 1971 and prior to that time, which are also $1 million. So you just, in this case, because you were, clever with your timing in order to generate the $1 million CDA payout on the capital gains and capital losses, are effectively precluded from paying out the $1 million of CDA that would otherwise have been generated on the death benefit under the life insurance policy. So fairly important timing point there. So CDA theoretically cannot be negative, but as a practical matter, it can be. And again, that is something that can burn people where you're not paying very close attention to the wording of the legislation. Everybody okay there? All right, then we can move on to problem 6 in handout number 15. And problem number 6 in handout 15 is asking us, what does the amount in paragraph A of the CDA definition in subsection 89.1 represent? And so paragraph A is the capital dividend account pot. And again, in its simplest form, the capital dividend account pot holds the excess of the corporation's non-taxable capital gains over its non-allowable capital losses on a cumulative basis from January 1, 1972 to present. And so to reinforce the point from the last slide, again, this pot cannot go negative per se, in that it cannot be less than 0 and therefore reduce the CDA balance to a negative amount, but it can function as an effectively negative amount that would block the payout of capital dividends, where there was a timing difference between the realization of capital gains and capital losses. The capital gains were realized first, and the CDA generated by the realization of the capital gains has been paid out. So in that case, a functionally negative but not actually negative balance in the capital gain pot could function as a blocker. So then we can flip to slide 8, and this is question 7 in handout number 15. And so in our question, we have XCO, which is a CCPC, and XCO has realized a taxable capital gain of $1,000 in 2021. And it's asking us, okay, so what do we include in CDA in 2021? And so again, we know that if there is a taxable capital gain of $1,000, then because we have a 50% inclusion rate under paragraph 38A, then we know that our total capital gain must have been $2,000. And therefore we know that the non-taxable portion of the capital gain must be $1,000. And so the CDA addition for 2021 is $1,000, and that gets added to the capital gain pot in paragraph A of the CDA definition in subsection 89.1. So that's relatively straightforward. And then the problem asks us to pivot in a different direction a little bit. So instead of realizing a 1,000 capital gain in 2021, instead the corporation has realized a $750 allowable capital loss in 2021, and then a taxable capital gain of $7,500 in 2022. And so again, the first thing that we want to do is we want to sort out our fractions, and we want to just make sure we understand our allowable capital loss versus non-allowable capital loss, and taxable capital gain versus non-taxable capital gain. So again, we start with the loss in 2021, and it's a $750 allowable capital loss. So again, given the fraction in section 38 is 1/2, we know that there must have been a $1,500 total capital loss, and therefore a non-allowable capital loss of $750. Similarly, in 2022, we know that there would have been if there's a taxable capital gain of $7,500, we know that there must have been a total capital gain of $15,000, and there must have been a non-taxable capital gain of $7,500 in 2022. So we sorted out the fractions, and now we can go and figure out what has happened. So in 2021, we realized the loss first. And so as a result of realizing this loss, we should have an amount that is included in the capital gain pot under subparagraph A2 of the CDA definition in subsection 89.1. But we have no capital gains, we have no capital dividends paid before then. So effectively right now, the result is kind of a nothing, just from an accounting standpoint, that we have no excess of capital gains over capital loss. So the pot is just zero, although as we're about to see, it's functionally negative. So then we flip over the calendar to 2022. And in 2022, we've realized this $7,500 non-taxable capital gain, and that would be included in our capital gain pot under subparagraph A1 of the CDA definition in subsection 89.1. But then at this point, our prior non-allowable capital loss kind of springs back into existence, because again, this is a cumulative calculation. So in fact, our amount by which the non-taxable portion of capital gains has cumulatively exceeded the non-allowable portion of capital losses is actually $6,750. And so that is our paragraph A capital gain pot balance. And that is the limit on what our corporation can pay out as a capital dividend. Okay, so is everybody okay there? Yes, so I have a question. Let's see. Just to clarify, so you review each pool separately to see if there's an excess of the capital dividends paid out so far and do not add amounts in each pool, and then see if this aggregate amount is excess in the capital dividends paid out so far. Yeah, so what you do is you compute each pool separately. So your capital gain in excess of capital loss pool, like that's computed separately, so you would figure that one out. You figure out your capital dividend received pot, which is just really easy, it's just receipts. You'd figure out your life insurance received pot, which is again fairly straightforward, it's just receipts. And so then you would add those three together, and the amount by which the total of those three amounts exceeds all capital dividends paid prior to that time is the corporation's CDA balance, and that's the amount the corporation can pay at a particular time as a capital dividend. So like we're talking about, the amount where you can see amounts added acting as a blocker with CDA is in situations where the corporation had capital gains and then paid out the CDA, and then after that time realized capital losses, which have effectively reduced cumulatively the corporation's capital gain pot to an amount that is less than the capital dividends paid prior to that time. So then if we have amounts that get added to either the capital gains pot or to the capital dividend pot or to the life insurance pot, we may not be able to pay it out as a capital dividend, or at least not all of it out as a capital dividend, because we may have a situation where where we have a functional blocker in the capital gain pot because we've cumulative on a cumulative basis actually overpaid capital dividends prior to that particular time. Yeah, I see a hand up from Leah. Go ahead.
So are we assuming then that the amount that gets added to CDA in 2021 gets paid out in 2021? Or
so,
like,
so in our last problem, in problem it would be problem 7, we were not, because there was no amount added in 2021 because there was just a loss. But what happens?
Oh, they're two separate hypotheticals. Okay, never mind.
Oh,
okay.
Yeah. Okay.
Sorry about that.
Yeah, no worries. Okay, so anybody else? Okay, seeing none, we can flip to slide 9. And this is problem 8 of our handout. And again, this is something that used to be relevant but is not anymore. But I'm keeping it in the materials for the time being, just because even when you get to practice as articling students or junior associates, you may have to deal with this on the litigation end of things as opposed to on the planning end of things. And so the question is asking what paragraph C.2 of the CDA definition represents. And paragraph C.2, this was the eligible capital property inclusion. So if back in the day with eligible capital property, the way it worked was that you would have a if you disposed of an eligible capital property, you would have what was called the cumulative eligible capital receipt. And generally speaking, what would happen was 50% of the cumulative eligible capital receipt would be included in income from business, because the goodwill presumably related to business. And then at the end of the year, paragraph C.2 of the CDA definition would include the non-taxable 1/2 of that amount in CDA. So that effectively, for CDA purposes, it was treated like a capital gain, although for refundable tax purposes, it was not, because it was included in business income. So it was very weird, and effectively that created a bit of a preference for selling goodwill versus selling anything else. And so finance fixed that by creating class 14.1 and pushing goodwill into class 14.1. So, and repealing at the same time cumulative eligible capital. So paragraph C.2 is still there, or at least it's still there as a ghost, even if it was repealed, because amounts that were added under paragraph C.2 but not paid out are still there and can still be paid out as CDA. So yeah, not too much that we need to say about that, because it's like I said, again, it was a trap for accountants because of the timing on when the amounts got added. But after 2017 or after 2016, no amount will ever be added again to paragraph C.2. So it's of historic interest, because running through all of the objections, appeals, rectification orders, etc., created by paragraph C.2 problems probably have not finished yet, but at some point in the very near future, it'll be irrelevant and it'll just be a historical oddity like some of the other paragraphs in the CDA definition that we've skipped over. So then we can move on to problem 10 of the handout, and this is slide 10 of our slide deck. And it's asking what paragraphs B and D of the CDA definition represent. So These, like we said, these are the really easy ones. If you've got your act open, you've probably looked at it, you've probably seen it. Paragraph B of the CDA definition is the amount of any capital dividend received by the corporation prior to that time. So, like I said, probably straightforward. It's just a receipt. It's just a category of receipts. And then paragraph D of the CDA definition Paragraph D of the CDA definition represents a death benefit under a life insurance policy. Sorry about that. Somebody's getting some feedback, so I just had to mute somebody. But yeah, so fairly straightforward. The rationale for both of these amounts being included is that these are both amounts that would be received, like we said, would be received tax-free by the individual shareholder of the corporation had the individual shareholder receive that amount tax-free. So if we want to be neutral, we have to make sure that the corporation has some ability to distribute those amounts tax-free to the shareholder when the corporation receives amounts that would otherwise have been tax-free had they been received by the individual shareholder directly. So everybody okay there? Okay, seeing nobody, we can then just go to our last question, which is on slide 11. And this is question 10 in the handouts, and it's asking a series of questions. First, about the election mechanism in subsection 83.2. And so we talked about this a little bit, that in order for a corporation to pay a capital dividend, it has to affirmatively elect for the dividend to be a capital dividend. And it does so by making an election, as the Act says, in prescribed form and prescribed manner on the earlier of the date that the dividend is paid or that any part of the dividend has become payable. So Regulation 2101 is the prescribed form and prescribed manner provision, and it prescribes that CRA Form T2054 is the form, and it requires that it be filed with a certified copy of the director's resolution declaring the dividend and a computation of the corporation's CDA pool immediately before the time that the dividend is paid. The other thing that you have to keep in mind is that if a capital dividend is designated is to be designated as a capital dividend, you do have to make the designation in respect of the full amount of the capital dividend. So if you want to pay out an amount as a dividend and you want some of it to be capital dividend and some of it to be a taxable dividend, you actually have to declare two separate dividends and then designate the full amount of one dividend as a capital dividend and designate or not designate at all the other dividend. So this is actually this is an important point to keep in mind, that this is distinct from GRIP and eligible dividends, or LRIP and non-eligible dividends, where you can designate only part of a dividend as an eligible dividend. So if you have an LRIP balance and you want to pay out the excess LRIP and then pay an eligible dividend on the excess amount that's not paid from LRIP, you can do that by making a partial designation under subsection 89.14. Similarly, with a CCPC, if you had a GRIP balance but you wanted to pay a dividend that was larger than the GRIP balance, you could designate only part of the dividend as an eligible dividend. You cannot do that with subsection 83.2 and capital dividends. Subsection 83.2 is pretty clear that you have to designate the whole dividend as a capital dividend. So you cannot only designate part of a dividend as a capital dividend. And so that is something that I have seen people mess up in real life, and fortunately it's been caught before anything got filed. But that needs to be very careful, because if you try to designate less than the full amount of the dividend, you haven't made a valid designation under subsection 83.2, and the result is that none of the dividend is a capital dividend if your designation is invalid. So some caution is warranted there. Then question 10 goes on to ask about what happens if a corporation has paid a capital dividend in excess of its CDA. And so again, we talked about this earlier, about 50 minutes ago or so, that if the excessive dividend arises, then what happens is that the corporation that paid the dividend is liable for Part 3 tax under subsection 184(2), and that Part 3 tax is equal to 3/5 of the excessive capital dividend. And so the excessive capital dividend is obviously the amount by which the capital dividend declared exceeds the corporation's CDA at the time the dividend was paid. So like we talked about, given what actual tax rates are, even on non-eligible dividends, that's a pretty steep penalty to pay, right? I mean, it's not a penalty, it's a tax. It functions as a penalty though, given the rates. So it's pretty steep. You don't want to pay that. So then the problem goes on to ask, well, how is this fixed? And it directs you to subsection 184(3). And that's the answer. Subsection 184(3) is the way you fix it. Is if you have an excess capital dividend, then the corporation and all of the shareholders who receive the dividend, other than tax-exempt shareholders, can elect for the excess portion of the capital dividend to be a taxable dividend that was received by the shareholders at the time that the original capital dividend was paid. The conditions for the election are specified across subsections 184(3) and 4. The important conditions that you'll see in those provisions are that the election has to be made within 90 days of the CRA sending the assessment for tax under Part 3, and that all of the shareholders who have received any part of the capital dividend have concurred with the election under subsection 184(3). In theory, you can avoid getting concurrence from all of the shareholders who receive the capital dividend if the corporation does not have a current address for any of those shareholders, and if the election is made within 30 months of the date that the capital dividend was paid. So that's great. Like if you pay a capital dividend to a shareholder and they disappear off the face of the planet Earth, then you could make a subsection 184(3) election without their concurrence, but it has to be made within 30 months. And that part is not so great because, as you will discover in the real world, the CRA is very slow. And oftentimes they will not have issued the Part 3 assessment within 30 months of the time the capital dividend was paid. And so you might not be able to rely on that exclusion for shareholders whose last known address is not known. So again, caution is warranted there, and it's usually a better practice to try and just get them to consent at the time the capital dividend was paid and hope that the CRA will accept that as a valid election and valid concurrence under subsection 184(3). So that is it for capital dividends. That was a nice short unit, and as promised, we have finished with time to spare today. Does anybody have any questions about capital dividends before we wrap up? All right, well, seeing none, it is very spring-like. It looks 12 degrees and sunny outside. So I'm going to let you go and enjoy the weather, and I will see you all next week.